With the unofficial end of summer, will we see a more volatile market in the autumn? I'm Tom Preston, Chief Market Strategist at tastylive. And in this week's Cherry Picks, we'll check out some data to see if autumn is more volatile, and watch until the end and we'll see how to take some opportunities in two stocks that are more volatile. Mike Reckentine and Nick Batista put out some interesting data here. The September to December S&P 500 moves in an election year, and in this week's election, in this year's election, it's going to be, fairly politically contentious. But will that actually have a big impact on the market? Well, we'll see. Because the guys went back to 1996, back in the Clinton election, through Bush, two terms of Bush, or 2 terms of Obama, Trump, and then Biden. And what they did was they broke down the monthly return each calendar month in those years. And what you see, what I see, is yes, the returns can be sometimes more volatile in election years than in non-election years. You see these big down moves in 2008, but then again in the 2012 election, they weren't really that volatile. You had other more volatile months that year. Same thing is true in 2020, where the most volatile. So what I see is a more random distribution of larger potential returns. Yes, the autumn can be more volatile, and that's because I've talked about the summer doldrums in the marketplace, where traders are on vacation or there's not a whole lot going on economically, maybe, and that can tend to just keep the market kind of quiet, or at least maybe drifting a little bit higher. And that's kind of what we saw this year until a couple of weeks ago, when we saw some pretty big sell-offs in the S&P. So are we going to see continued volatility into the fall? I don't know. The question is, some presidencies have bigger economic impacts than others. And I think with the uncertainty headed into this election that might be more political than economic, I'm not sure if the volatility is going to increase that as much as we've seen in some of these past election years. What I'd suggest is, now that we have seen a market sell-off with volatility increasing, take the opportunity as it presents itself. So to go back and look at some of this data again, we see the average returns per month, and these months here, September, October, November, December, this is the average returns. Are they larger or smaller? Yeah, they're a little bit bigger than in the rest of the month. The median, again, the in between, where they're half above, half below. Yeah, it's somewhat more volatile. The standard deviation of returns, I can't say that it's significantly larger than in the non-autumn months. So again, use this information, as you will as a trader. Just keep it in your back pocket and pull it out if you see some volatility in the fall. But again, I would take advantage of any increased volatility, because it doesn't always last that long. As we go down and look at some of the earnings coming up this week, Dollar Tree, Hormel Foods, Copart, Hewlett-Packard, Avgo is kind of the big one, Broadcom, Oracle. There's some interesting earnings trades, and if you want to take risk through earnings, these are some opportunities. Some of these stocks are more liquid than others. Adobe, for example, Oracle, and AVGO are pretty liquid. Dollar Tree is also. But what we're seeing is the big one is Broadcom, AVGO. Revenue has been increasing every year, but net income has been weak. Will this affect earnings? Who knows? The earnings are coming out at the end of this week, probably before you actually see this video. And yeah, we've seen some pretty high volatility in AVGO particularly, and also just carrying over from increased volatility in the sell-off in stocks like NVIDIA. Okay, so a lot of the technology stocks have been getting whacked recently. Open up the platform. Here's the S&Ps The S&Ps had a pretty big sell-off this week. Sell-off here ahead of earnings. Nvidia was the weakest on the board. That got crushed over these past few days and then has bounced back a bit. But that's what's happening in the broader market. And so what you see is an increased volatility. Let's take a look at the trades the guys are looking at here. The first one is a SPY iron condor. September seems to be the weakest month of the year based on historical look back. As of today, we're seeing a nearly 1.5% pullback and a significant 10% increase in volatility. What are they talking about? Well, what they mean is this number over here, let's say 21% in volatility, is much higher than what it has been. Let's take a look at a chart of the VIX, and you'll see that increase in volatility. Again, the VIX is a measure of the volatility in the S&P 500, and the SPY is the ETF that tracks the S&P 500. Therefore, looking at the VIX is a good way to see what the volatility in the S&Ps is, or SPY is. And as you saw, we have a huge spike up in the VIX when the S&P sold off. And again, they've been climbing a little bit higher as we're, again, after the unofficial end of summer and Labor Day, a little bit higher volatility. That's what they're talking about, the increased volatility in the SPY. So what they loaded up was an iron condor in the October expiration with about 43 days to go. They're buying the 520 put, selling the 535 put, selling this 575 call, and buying the 590 call. So 15-point iron condor. Let's take a look at that trade. And it's 15 points, and we're going to see what kind of credit you get for that versus the risk you're taking. So let's go to the October expiration. The 525.35. So I'm going to buy the 520 put, sell the 535. I'm going to sell the 575 call and buy the 590. And that is indeed an iron condor. It takes in a credit $4.10, has a $1,000 90-cent capital requirement, 84% probability making half its max profit, not bad, generates $5.45 of daily theta. But if this were a little rich for your account, in other words, $1,000, $1,100, might be a little more than you want to allocate toward a trade. Let's see if we tighten up these long options. So instead of the 520 put, let's take a look at the 530. Let's buy the 532 put, create a 3-point put spread, and then go down from the 590s to the 578s and create a 3-point call spread. So this is a much tighter iron condor. Now look at the margin requirement. The buying power effect is only $185. Max profit is $115. We take in, and what I look for is a general metric of about 1/3 the width of the strikes. You get that with this 3-point iron condor. You didn't quite reach that credit with a 15-point. So looking at this 532, 535, 575, 578 iron condor, yeah, I mean, it's got a 69% probability of making half its max profit, generates $1.25 of theta. Compare that to the higher theta of the 15 points. That's what you get when you take more risk with wider strikes. But again, if you want to take more risk, yes, you can do the 15 points. If you want to allocate more capital, great. If you have a smaller account or don't want to take that much risk going into what could potentially be a more volatile fall, yeah, check out the 3-point iron condor. Let's take a look at the next trade, and this is the Broadcom trade, the AVGO, a short strangle in October. Nvidia traded well inside the expected move on earnings. That is true. Even though it had a big move, the expected move was gigantic. So maybe the same is due for Avgo. Okay, it has a significant call skew. What does that mean? It means that if I go in here, AVGO, and I look at the October options, stocks at drop a lot. It was 145. The earnings came out today. That's why it's down about $7 right now. So let's just take a look at the 152s. What they're talking about is take 152, go down 10 points. The 142 put is 540. Go up 10 points to the 162, 825. That is call skew. In other words, when I see equidistant out of the money options trading higher on the call side than the put side, this skew is pointed towards the calls. And so that's what they're talking about with the call skew. What they're doing is they're for a neutral trade. If you think Avgo is going to trade in a range, just like the SPY, if you think it's going to trade in a range and Iron Condor is the trade. If you think Avgo is going to trade in a range, it's going to stay within its expected move, selling the 130 put and selling the 175 call. Let's take a look at that trade. 130 put and 175 call. Yeah, okay, so taking in $5 of credit, not bad. $15 of theta, 82% probability of making 50% of max profit. Again, $1,453 of capital requirement to do that trade, as well as unlimited risk. Okay, you have no protection on this trade. So let's see what happens if we buy, let's say 2 point out of the money options to turn this into an Iron Condor. This is what an Iron Condor is. It's a short strangle with some long options further out of the money. So let's buy the 128, and by the 178, what do we get? $1.87. That's a little low. Let's pull this down 2 strikes, and this down 2 strikes, and this up 1 strike. And this is just creating a trade that matches the criteria I'm looking for. Third of the width of the strikes. I'm not quite getting it. Part of it is the market's fairly wide. But what you see is with this, that's 3 point, oh, this is wide, okay. 3 points here. So I get a 3 point Iron Condor for about $1.08. I could do a 2 point if I really want to tighten up the risk and get about 70 cents. That's about a third of the width of the strikes. Again, buying power effect is $131. If you have a smaller account and want to make a bet in a trade like Avgo, which is a $150 stock, it gets pretty expensive to trade the options naked. An Iron Condor defined risk trade where the max loss is 130, max profit 69. I have a 66% probability of making half that profit, or about $35, and $1.06 of theta. That's not bad. So those are 2 potential trades to take advantage of higher implied volatility in these products. If you want to get the cherry picks delivered to your inbox every week and my cherry bombs every day, click on the link below.